Welcome everyone to today's program. I am Ayla Ellison with Becker's Healthcare. The program will begin with a presentation and we will have a question and answer session following completion of the presentation. You can submit any questions you have throughout the presentation by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Our presenters will attempt to answer as many questions as they can during this time. You will receive an email within about a week following the webinar that will include instructions for how you can download a copy of the presentation. You will also receive a follow-up email shortly after completion of the program. You can submit your feedback or any additional questions at that time. This email will include the presentation. It is now my pleasure to introduce today's presenters. Vic Basichero is currently a Corporate Senior Vice President with Scripps Health in San Diego. Since joining Scripps in 2001, Scripps has been recognized by AARP and Working Mother magazine as a top employer, as well as being ranked number 42 by Fortune magazine's 100 Best Companies to Work For in 2016. Additionally, Scripps has been recognized by National Association Female Executives as a top employer. Vic has more than 30 years in healthcare and human resources experience. He joined Scripps from the Providence Health System. Prior to his tenure at Providence, Vic served as Senior Vice President of Human Resources and Organizational Development for the Banner Health System and as Senior Vice President of Human Resources for the Samaritan Health System, which is now part of Banner. During this time, he led new programs for leadership development, service excellence, reduction in employee turnover, and improved employee satisfaction. His efforts at organizational development and effectiveness were recognized by Franklin Covey with the 1999 Organization of Excellence Award. Vic has held senior executive roles in Presbyterian Health System and Baptist Health System. Vic is a frequent speaker at the national level and has served on the board of directors for various corporations. Our second presenter today is Mr. Gutherman. He's the co-founder and principal of Trisend NP. Prior to Trisend, Mr. Gutherman served as president and CEO of Wealth Management Strategies Incorporated, a financial services firm which he established in 1996 in order to provide key services in the estate and tax planning areas, as well as in the executive compensation area, to accounting and legal firms around the country for their high net worth individual clients, closely held businesses, and not-for-profit entities. As a result, he has successfully marketed many sophisticated concepts in these areas and has forged strategic alliances with a number of the nation's leading accounting and legal firms. Mr. Gutherman has over 40 years in the financial services industry. As a principal and owner of a large property and casualty company, he successfully negotiated the acquisition of his firm by a major New York Stock Exchange company. Mr. Gutherman pursued a degree in political science in New York University. Our third speaker is Mr. Edwards, and he is a co-founder and principal of Trisend. Prior to Trisend, Mr. Edwards served as Chief Executive Officer of Professional Holding Company, LLC, a diversified holding company offering participant benefit design and underwriting services and third-party administration. The company offers a wide range of financial products and services to organizations and their key executives, including sophisticated advanced case modeling, underwriting, and servicing. Mr. Edwards has over 20 years of experience in advanced employee benefit design, investment banking, mergers and acquisitions, transaction engineering, and financial products, and has held several senior positions with responsibilities ranging from development, acquisitions, and operations. Mr. Edwards holds a Bachelor of Science in Biology and Chemistry from Whitworth College, where he also pursued a Master's in Health Services Administration. It is now my pleasure to turn the floor over to Vic to begin today's presentation.
Good afternoon, and in some cases, if you're like me, located on the West Coast, it's still morning. I'd like to thank all of you for joining us today, talking about an emerging issue that we see in our industry around a topic that's not well vetted or discussed much, which is really around a lot of executive retirements. Typically not discussed much publicly because of the public optics, so to speak, of the compensation that many of our executives are receiving and how people react to healthcare compensation in general for executives. But secondly, also I have a tendency to be very private arrangements between boards and chief executives or other senior officers, and not well publicized even within their organizations. And to some extent, for a lot of us, and I know in the case of Scripps, not well understood until executives began retiring. One of the things I would want to point out as you join us is both Bob and Dale and Tricend as an organization work generally across the country, and you can see the representation of endorsements, current clients, and recent clients of Tricend, who really help engineer organizations, engineer solutions for people in wealth building, particularly in retirement perspectives. So as we move to the next slide, I'd like to talk a little bit about a story, fictional, because I didn't want to use any other organizations or even any of Scripps executives, although I'll refer to them briefly, in terms of what kind of exists today. And typically we have a CEO that is somewhere getting towards retirement, and the board wants to do something with them, and the CEO wants to work a certain number of years. At Scripps, are variations to those examples where executives 65 plus who want to continue, or executives short of 60 who have different objectives, all covered by different types of arrangements, typically a SERP. And those SERPs present some issues with each of these executives over time. Typically what a board would want to do when they're thinking about a chief executive, on the next slide, but think about how do they want to retain Joe in typical situations. As we know, CEO tenure is getting shorter and shorter. Some of that is movement of CEOs, but it's also a tumultuous time. And in that arrangement of retaining, they also want to typically provide for retirement in some form or fashion. In most cases, the stewards of the hospital resources are important, particularly as a not-for-profit. But even in a shareholder-owned organization, the steward of resources is critical in terms of how shareholders look at the wealth accumulation. Other things the board are also very concerned with today, of course, is reasonable compensation, particularly when you can match that against the market, and public optics, as these arrangements get disclosed both on 990 as accrued and their 990 reporting, but also when paid, and many times people's names show up with compensation amounts that look like they're some of the highest paid people in the country, when it is merely the distribution of a retirement plan to the executive as they're leaving the organization. And generally a board noodles over these things in some form or fashion, and in the past has typically used a SERP targeting some level of benefit for senior executives like Joe. Sometimes those will be individually designed for an executive, but many times in an overall executive SERP plan for a cadre of individuals, generally the top few in an organization. What they typically target in that goal for Joe is they try to target some level of comfortable retirement, and you'll see that on the next slide. And in this case, this board kind of was targeting $100,000 a year for life, through life expectancy. Many organizations will use a function of final average earnings. For Scripps, for example, we have used the final 60% of final average earnings of the 5 highest years paid, or the final 5 years of pay. Others use other sorts of combinations integrated with Social Security and things of this nature. In this kind of case story, the board kind of wanted to make sure that they gave $100,000 a year for life expectancy. So we have a target that the board feels is important. And if you spin forward 5 years from Joe's fictional 55 that we started with, he's now 60 years old. And at 60, you begin to see that when you look at the returns on the plan, typically they're substantially behind schedule. And why is that? Many times it's due to assumptions built in the plan, which we'll talk about in just a moment, but it could be a whole host of stuff. As Joe's looking at this and he sees, I'm 60, the plan looks like it's behind schedule. Do I retire less? Do I work longer? as in some cases, if we see across the country as executives get close to retirement age and find out what their retirement benefits are, they postpone retirement and clog up the system in terms of succession. I personally am involved with one organization across the country, which I've worked with both the CEO, the COO, and the Chief HR Officer, who've actually had that reality occur, in which succession was planned. CEO came right up towards retirement and discovered that he was going to be short what his expectations, is now delayed, and the COO, who's teed up and ready to go, is now in a frustrated perspective in terms of thinking, when will he finally become CEO? So there are a couple of ways to approach this. Does the board make this up? Some boards do. They make up what the expectation is. Some will not. In the case of Scripps, as we had individuals move to these levels, our board was very rigid in terms of holding to what was originally approved, and actually conveyed market risk to the executive and felt that that market risk was appropriate. So let's see how this now reality spins forward with Joe when we look at Joe's side-by-side comparison. And we can look at the original assumptions and annual contributions with 10 years of contributions from Joe's 55 years old when we set up the plan to 65 now. The retirement, pre- and post-retirement interest rate assumptions that were given, which are kind of traditional in most plans. Scripps, in fact, used the 7.5% discount rates and interest rates as we went through our cert, and look at tax rates, gains on tax or losses, and life expectancy to come up with a lump sum benefit from his retirement plan. And so when we begin to look at this and compare to what took place, we can tell our assumptions really are the key of determining whether this plan is successful or falls short. And what are some of those things that cause it to fall short? Well, first of all, we know today return assumptions are very different than many of these plans adopted decades ago, which assumed a 7.5% interest rate in terms of returns, and therefore when paying out benefits used a 7.5% discount rate, assuming that once you got a lump sum, you could go out to the marketplace and get 7.5%. I'm not sure of many people that are getting 7.5% in the marketplace today. In fact, I struggle getting 2 and 3% on an individual basis. And then when I look at how many plans function, retirement plans, many of them fall short of this 7.5%. Those expectations around that interest rate can really create some risk and and shortfalls for Joe, as you begin to see. And the other major one is when originally adopted, life expectancy was expected to be 17 years, but with our good healthcare system, life expectancy is now 23 years. So the per year payment of $100,000 a year actually stretches out a few more years. However, the assumption of benefit is based on 17 years. So as you can see, the lump sum retirement benefit after discounted on the original assumptions versus what actually took place is a significant haircut for Joe. So as Joe is hitting 65, you can expect that as he's looking at getting $52,000 a year versus $100,000 a year, he's probably reevaluating his career and figuring out what he can do going forward. And those areas of looking at the benefit, whether it be how the discount rate hits or the returns expectation of the life expectancy, are creating across the country today some significant disappointment for our people as they look in the face of retirement and what was thought to be planned and promised by the organization. And although many of these are unqualified plans and a board can change its mind and unqualified can just pay the benefits it'd like to, you can imagine the discouragement both of the board and the executive when reaching this level and finding out that the commitment of the board, at least intent, was not in fact created in reality for the executive and how the executive feels appreciated. So what happened in that process? And I think what you can find when you begin to drill into this as we move to the next slide is that many times we rely on the wrong experts. Now, what do I mean by that? Well, we all use compensation consultants. They're the best folks to help us establish a rebuttable presumption of reasonableness in terms of fair market compensation for our executive teams. And the boards rely on these compensation experts. But as they determine how much should be paid, many times we rely on those very same comp experts who determine how much to try to figure out how to pay it. Well, those are two very different kinds of skill sets. And so they, as most compensation consultants do, is they have a tendency to focus on more traditional approaches. And the result in this case happened to be, and it happened with Scripps on multiple occasions, missed expectations by both the board and Joe. So with that, in effect, what happens is our cause and effect is somewhat significant in that the very assumptions that we took in place in the design of the plan, in fact, caused the shortfalls to begin with. As we move forward, I'll turn it over to Bob to talk a little bit about what are some of the factors in terms of how people are approaching these various options that exist in the marketplace and how people are beginning to approach what to do about these so-called shortfalls.
Yeah, this is Dale. I'll be happy to pick up from here. Good afternoon or good morning, everyone. I'll spend a few minutes talking about, sort of picking up on what Vic just talked about and really address cause and effect and what we see, having had the benefit of pulling apart over 30 large healthcare system retirement plans over the last couple of years, what we're seeing and some potential solutions to solve the issues that we're out there seeing. We start with a very basic conversation, and that is that there's a difference between cause and effect and correlation. And we see an awful lot going on out there in the healthcare industry where there's discussions about false causes, and we think there's three primary reasons why we're seeing a significant underfunding or under-benefiting of these retirement plans. I remember chatting with my 11-year-old son years ago about the difference of and the relationship of cause and effect, and we talked about the famous story that there's firefighters that show up at every fire, therefore firefighters must cause fires. Obviously, that's not the case, but if you sort of think of that little example and that simple example, you'll realize that maybe it's time to step back for a moment and really look at what's really going on with these retirement benefits and try to identify what the real causes are. So if you'll move to the next slide, please. As I mentioned earlier, we've had the benefit of pulling apart a very significant number of healthcare systems and their underlying retirement plans over the last couple of years. And what we see is typically an average of 30 to 50% underfunding. In fact, of those 30 healthcare systems that we've looked at, we've only seen one that's been adequately funded. And what do I mean by that? Well, as Vic said earlier, either they're underperforming, so they're going to deliver a retirement benefit to the executive that is far less than what everyone originally expected, both the board as well as the executive themselves, or it's underfunded because the organization is going to have to come up with a significant increase in funding in order to address that shortfall. And it really comes down to who's going to bear the underlying risks associated with the plan. And so if you'll move on to the next slide, please. And we're finding, by the way, that that's not true just in healthcare. It's true nationwide. For those of you who are not familiar, there's actually a terrific set of research and data available through the Center of Retirement Research at Boston College, who really looks at this as well. And they look at a variety of different things that cause these plans to be underfunded or underperforming. And one of the things that you're going to see right away with this graph is that this move over the last couple of decades to push the risk from the organization in the form of defined benefit plans to the executive in the form of defined contribution plans has interestingly caused rates of return to get worse. And one of the things that we really study is, well, what are the reasons behind that? What are the things that cause rates of return to get worse simply because of who's bearing the risk associated with the plan? And specific to healthcare, if you'll go to the next slide, you'll see that healthcare also is experiencing this. There was a very interesting article in Modern Healthcare last year that looked at defined benefit plans. And these are plans that are very professionally managed, usually sophisticated investment managers. And as we saw as we moved from 2013 to 2014, that in fact the pension obligation got worse in a year in which rates of return, investment returns, was actually pretty stout during that 1-year time period. And you may say, well, gee, we don't have a defined benefit plan. Well, the point we're trying to make is it really doesn't matter whether it's defined benefit or defined contribution. It really doesn't matter who has the risks. At the end of the day, rates of return, and more importantly, the timing of rates of return, is very critical to the success of these plans. If you'll move on to the next slide, you'll see that we're really trying to help you get a sense of what we're seeing out there, and that is that there's an awful lot of discussion about false causes. And we don't think that these things at the end of the day really address the underlying issues associated with these retirement benefit plans. And we consistently see 3 false causes that people talk about. The first is who bears the risk. And the real sense there is that if all we do is just adopt a defined contribution plan and put a certain amount of money into a plan over a period of time, that we really don't have to worry anymore about whether or not there's a benefit here that's being provided, or a specific benefit being provided to the executive, because we're not guaranteeing a particular benefit. Well, we find that that's really not the case. That ultimately the executive does get, as they get close to retirement, and sometimes it's too late at that point, they start to really realize that they're going to get far less than what they expected. And we've even seen situations, as Vic mentioned earlier, where that causes the CEO or the other executives that are involved in the plan to delay retirement as a result of that. So who bears the risk really doesn't impact the success or failure of these plans. Complexity is another issue. There's a sense that if we could just simplify the plans and give the executives a certain amount of money every year, that will somehow solve the problem. What we find is that all plans have a certain level of complexity to them, as I'm sure many people on this phone call could attest to, and simple doesn't necessarily solve the problems. And then lastly, we find that there's just folks that have given up. And they say, you know what, it's hard to manage the market, it's hard to manage life expectancy, there's really nothing we can do about it. Again, we find that nothing could be further from the truth, that there are in fact a very unique set of products out there that can in fact address a lot of these underlying causes. And so as we move on, Vic mentioned this earlier, and if there's one thing that we really would like y'all to leave with today is an understanding that there's a difference between how much and how. He mentioned earlier that compensation consultants, everybody's familiar with them. They do a terrific job in helping not-for-profit organizations determine the level of reasonable compensation. But we find that it's pretty tempting when that process is done, what we call how much, to then look to those folks and say, well, let's go to the how. Let's go to how we're actually going to do that, how we're actually going to fund this plan, what kinds of products and designs are we going to use to address the underlying causes that have created these underfunded plans. How do we manage those risks? And so there's really a new thought out there, especially in not-for-profit organizations, even though this thinking has been around for a long time in for-profit organizations, that there's a separate role, there's a separate set of experts out there, benefit brokers, who really can deal with designing a plan, can deal with how you fund a plan and how you service a plan, so that you can revisit frequently how in fact these programs are doing relative to the original expectations. And so we find that this working cooperatively between compensation consultants and benefit brokers is the key to really understanding the difference between how much and how. Ask yourself the question as I go through some of these next slides, is the conversation about what should keep you up at night really being talked about? And these are the 3 causes, the real causes associated with benefit underfunding. investment volatility is the first one. Notice I didn't say rate of return, because volatility or internal rate of return or the sequence of returns is really the much more fundamental issue. And you'll see that in some of these later slides. The timing of returns is far more important than the average return. I also, in the previous slide, if we could go back to the previous slide for just one moment, I also wanted to mention the importance of costs, and costs includes these products' underlying costs, their fees, and importantly, the taxes associated with the overall plan is the second root cause, the real cause. And then lastly, life expectancy. Life expectancy is increasing dramatically, as you'll see in a moment. In fact, the actuaries are now telling us that the first person who's going to live to age 150 has already been born. It's kind of ironic, as Vic mentioned earlier, that the healthcare system is doing such a magnificent job of increasing life expectancies, but you have to bear the burden of that in terms of how you ultimately fund these plans. But the good news is there's some products out there that really do address these underlying issues. So let's talk about investment volatility first. And I mentioned earlier sequence of return risk. Really the thing that we want you to get from this slide is that it's impossible to predict markets. And if you're a CEO who was fortunate enough to retire in 1995 versus a CEO who was unfortunate enough to retire in 2000, you'll see that if in those two scenarios, retiring with exactly the same amount of money does in fact have a dramatic difference in terms of what they'll ultimately realize in terms of retirement income. And that's the gold bars on the left. And we're going to introduce a concept as we go through this presentation of collared investment products, the idea that you can hedge returns and collar returns so that you have far less volatility in your retirement income products. And that's what we are now beginning to communicate to you with the black bars on the right, the idea that there are some very well-known products out there that can address investment volatility, and in doing so, significantly reduce the probability that you're going to have an underfunded plan. And so if we go to the next slide, if you're familiar with the, going back to your statistics class in college, you may be familiar with these bell curve ideas, but basically what you have on the slide right now is the range of investment returns over the last 15 10-year periods in the equity markets, specifically the S&P 500. And you look at something like that as an investment professional and you say, how in the world could you ever possibly build a plan with that level of volatility? You'll see that there's a range of returns here that range from negative numbers to very large positive numbers. And so the idea that you could build a plan around this level of ranges is sort of preposterous. And so one of the things that we do is we look at investment products that are out there that can give you a much tighter and more consistent rate of return or internal rate of return by managing the volatility of the market. Now, one of the ways in which people do that is they look at bonds. But unfortunately, if you look at highly rated bonds over the last, again, 15, 10-year periods, they look pretty good, but over especially the last more recent 10-year periods, they've been far to the left of that bell curve because of declining interest rates. And so that concept that we introduced earlier of a collared equity product, or what we call an index product, does in fact create a very nice tight rate of returns, if you could progress the slide please, that is consistent with and more predictable in terms of actually building a retirement plan. And so if you go on to the next slide, the way in which some of these products work is they'll simply take an index such as the S&P 500 and collar it. They'll reset every year, and if we use 3 very interesting years to sort of demonstrate the point, these products, these retirement investment products, can show you a range of returns that fall within that collar, in this case a 0 12.5% collar, in which if, like in 2007, you fell within the collar, you get that rate of return. If you experience a 2008, which for those of us who have retirement plans, we all remember 2008 as being a very difficult year. The key to successful retirement planning is to eliminate these types of losses, even if it means capping your gains. And so notice with these types of products that in a very difficult year, you end up holding your gains, and then in positive years like 2009, you participate in the gains going forward. What kind of impact does that have to retirement benefit planning? Well, if you go to the next slide, you'll see that these products not only have very low expense ratios, and there's a real move right now in retirement benefit planning to really avoiding actively managed funds and going to low-cost index funds, whether they be equity or bond-based index funds. That's important to addressing the second root cause of these underfunded plans, which is significant fees. And if you go on to the next slide, you'll see that a lot of these products over the lifetime of the executive, and we really encourage people to take a look at the lifetime expense load of a particular plan, you'll find that a lot of these products actually have significantly less expenses, especially if you include taxation as an expense over time. Going on to the next slide, most importantly, we're addressing life expectancy. The life expectancy of the executives that we service is well in excess of the typical mortality tables that people were using in the past to build these plans. In fact, it's important not to use large annuity tables or large population life expectancy tables when you're building these plans. You really have to look at the law of small numbers when you're building a plan around a small group of executives. And in fact, best case scenario is to actually individually underwrite them so that you can get a sense of what their real life expectancy is at a moment in time. But even ignoring that for a moment, you'll see that the vast majority of the mortality tables over the last 15 years have seen significant upticks in what we think life expectancy is going to be. So if you move on to the next slide, I'm going to turn it over to Bob. And so but before I do, just keep in mind there's a big difference between how much and how. That's what Vic meant when he mentioned pick the right experts to address each of those two distinct issues. And lastly, focus on the real causes of what's causing these plans to be underfunded: investment volatility, costs, and life expectancy. And so I'll turn it over to Bob, and he'll share with you just a couple of different things that we've done with some of our clients in the past to address those issues.
Thank you, Dale, and good afternoon or good morning, as Dale said earlier. Now it becomes a question, as Dale alluded to, of how do you take advantage of what we just covered? How do you take advantage of the types of collars that can mitigate volatility? And how do you take advantage of the difference between how much and how? And over the next several slides, we'll just see several examples of how we've been able to implement programs that basically take advantage of some of the concepts that you just heard Dale go over. The first one is a program that we call KEEP. It's an acronym for Key Employee Engagement Program, but basically how it works is funds are contributed to a life insurance contract on the executive's life, and as we all know or should know, the funds in a life insurance contract grow on a tax-deferred basis. But perhaps more importantly, in this particular contract, the way that the crediting works is by virtue of the collar that Dale just went over a few slides ago. So each year, the contract is credited with the performance of a major index. It's the S&P 500, but it's subject to that collar, where the floor is 0, the cap is 12.5%. So the net result of that, as you'll see in a subsequent slide, is that the volatility, which is the real bugaboo of these types of programs, is mitigated. And I'm sorry, if we could just go back to the previous slide. again, this particular program, there's no capital recovery, meaning this is a more traditional type of program in that the funding could be the same, and I'll explain why I say could in a moment. The executive recognizes income at vesting, meaning there are certain methodologies we can use here that would place restrictions on access to the funds depending on various vesting options. And there is a 30 to 50% greater efficiency in using this type of program, primarily as a result of the type of collar we've been discussing. And it's interesting, as we have worked, and I have worked with various health organizations, they'll use that 30 to 50% gain in efficiency in a variety of ways. They'll either use it to enhance the benefit to the executive, or they'll use it as part of a cost reduction program to save the organization money, or in a third scenario, they will blend the two. They will implement a program like this, enhance the benefits for the management team, while also recognizing some savings in the process. And if we look at the next slide, you can see that in action, where the actual results in a regular program would have produced that $52,000 of income to an executive between the ages of 65 and 84, 20 years, whereas the KEEP program, because of that collar and its greater efficiencies, is going to recognize almost a 64% improvement in what the executive will realize during retirement. There is no lump sum at retirement, unlike more traditional programs, but the greater retirement income and the fact that this carries with it also a death benefit to the beneficiaries, which is available from day one, kind of balances that out as a result. So if we can go to the next slide. As you're probably all too familiar with, most other programs result in a permanent loss of capital and assets of the corporation and the healthcare organization. And we'd like to show you one last technique that we used, which is called CapEx, which basically leverages the corporation's, the healthcare organization's balance sheet in providing funding into two very differently designed life insurance policies on the executive's life. The one on the left, the repayment policy, has a mission, and as its name would imply, that is to repay the entirety of the funding back to the healthcare organization, while the policy on the right is designed very differently, and that's to facilitate the growth of cash so that during retirement, the executive can draw tax-free retirement income for a period of time. Usually 20 years is how it's designed during that period. This is recorded as a receivable. It's an asset on the books of the corporation. It is not, interestingly enough, recorded on Schedule J of Form 990. This is deemed to be a non-compensatory plan by the IRS. So to that extent, it does not get recorded as a additional compensation. So again, this provides, as you saw earlier, a much better result for the executive. If we look at the next slide, where the original plan would have produced $100,000 or was targeted for that, the actual results were coming in at almost half of that. With CapEx, we're able to achieve a greater return for the executive and remedy any broken plans that we come across that are out there. You see what the net retirement income is. The cost recovery, capital recovery to the organization here with CapEx is $10 million. And when you factor in the avoided expense and the recovery itself, that produces an internal rate of return to the health organization of about 5.3%. So with that as the two examples, if we can just go to the next slide. You wanted to leave some additional time for questions and also to hopefully have provoked in those of you listening, do you have any real idea of what the current program, which may have been put in place years ago, is going to ultimately provide to you and to your executives?
Thank you to our presenters for a very informative and enjoyable presentation. We will now begin the Q&A portion of the program. As a reminder, you can submit any questions you have by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Our presenters will attempt to answer as many questions as they can during the time we have for Q&A. So we'll go ahead and jump into the questions that have already been submitted. And the first question refers to, it looks like page 6 of the slides, but it says on page 6, why are plans behind schedule? Is that because they were poorly designed?
This is Dale. I'll jump in on that. I wouldn't say that they were poorly designed. Certainly, you have the benefit of hindsight whenever you look at a plan that was put in place years ago. I tend to think that, and this is based on our experience of looking at dozens of these plans and really testing them for what went wrong, I think, one, it's the how much versus how expertise we talked about earlier, that there are folks that are really good at one thing and there are folks that are really good at another thing. We think that these are sophisticated plans that are built and ultimately succeed or fail based on the veracity of the underlying assumptions and the way in which you manage those assumptions so that you have the highest probability of success. And so our experience is that those three root causes of investment volatility, costs, and life expectancy generally have not been addressed. I mean, ask yourself the question, if market rates of return had been stable over the last 30 years, life expectancy had not increased, and costs were low, would folks have been moving so aggressively from defined benefit plans to defined contribution plans? Would they have been moving aggressively towards sort of moving away from even thinking about the plan as providing a specific benefit? I think the answer is clearly no. And so those must be the root causes, to answer your question specifically, and the reasons why plans have underperformed in the past.
Dale, this is Vic, and I think another feature of this is typically the plans are very well designed. And some plans, as we know, defined benefit type of plans, have automatic adjustments, whether they be to interest rates. The plan document itself may say the plan must reflect contemporary interest rates or the interest rate of the day as defined by some index, or it may automatically update to mortality tables that are new. So a plan adopted in the 80s that might be using a 1971 mortality table might be forced to update to something more contemporary as 2013 or whenever IRS may update those. In those cases, and frankly, as I've talked to some of my peers across the country, they have watched those plans from December to January as they're forced to update life expectancy tables go from being fairly well funded to being short a significant amount just by the mere change of that life expectancy table. So that's on one side of what's underfunded. So in those organizations, the organizations have an obligation to meet that defined benefit, and they've built in updating features in their plan. Other organizations adopted plans that had somewhat static assumptions. That was the case in Scripps. And the board had decided, based upon those assumptions, of a 60% income replacement. Well, as we moved in contemporary time periods with interest rates at a much lower level and the mortality rate tables updating, some of our executives would say, frankly, when I apply the discount rate to my lump sum and I look at the lump sum based upon 17 years versus 21 or 23, I'm only getting 50% or 40% income replacement, not 60. So the dilemma is on either side, and as you can see that, and those are as Dale has commented, those factors create issues in these qualified plans or defined benefit plans.
Thank you, Dale and Vic. I'm going to go ahead and move on to the next question. And it is, I have a SERP that will fund 60% of the last 3 years' average salary offset by 401k contributions at a fixed rate of 7%. When the SERP funds, I will pay at 40% in taxes. Is this a good SERP?
Well, I think that how much people would tell you that that's a competitive SERP. I think the how people, obviously that's who we are, would ask the question, do you really think that you've made a 7% rate of return pre-retirement if it's a funded plan? And do you really believe that you're going to generate an internal rate of return after tax, because that's usually how these things are set up, of 7% post-retirement? And if you look at the most recent 15, 10-year periods, as Vic mentioned earlier, that's a stretch. And so the question is, what is being put in place to mitigate or manage that risk? So it's hard to comment without looking at it specifically, but I think at least my answer would be that the how much people would tell you that's a competitive SERP, the how people would question the underlying assumptions.
Right.
Thank you very much, Dale. And the next question is, what carrier products do you prefer?
I beg your pardon, I couldn't hear the question.
What was it? Yeah, what was it?
I apologize. The question is, what carrier product do you prefer?
This is Dale.
Go ahead.
Yeah, go ahead, Bob.
No. Go ahead.
Okay. Well, I think the question is a question about which types of products do we prefer. I think that the way that we would answer that question is that first and foremost, we have an affinity towards mutual companies simply because they were able to very nicely endure and candidly thrive as we went through the financial crisis over the last 10 years, simply because they're not beholden to public interests or shareholders. They do what they do because they're first and foremost about taking care of their policy holders or their product holders. In many ways, if you think about it, that's a lot like not-for-profit hospitals. That's what they're all about as well, and we just have affinity towards them. And then there are the obvious answers as well. They've got to have been around for over 100 years. They've survived all kinds of things. They have terrific ratings, that sort of thing. And then finally, these collared products have been around for a long time. We've always been sort of surprised at how few people know about them. But there are some companies that are just a lot better at it and have a lot more experience at it than others. So I think that would be the answer to the question, at least from my standpoint.
Thank you very much. And moving on to the next question, it is, isn't the CapEx approach reported on the Schedule L form of 990, where there could be very large loan amounts shown?
The answer
Bob, why
to
don't you take that one?
Yeah, since I think referenced the fact that it was not reported as additional Schedule J income. Yes, in fact, it is reported on Schedule L, but what we have found, and we help various healthcare organizations craft this message, there's room on Schedule L for a narrative that basically lays out the basis for the arrangement whereby the healthcare organization and the executives have entered into this arrangement whereby all of the funds plus a rate of return will be reimbursed to the organization and is secured by the use of life insurance products. And usually what we find and what the healthcare organization finds is that that's a better narrative, it's a better optic than just being additive to Schedule J as it would be under more traditional types of programs.
Thank you, Vic. And the next question is, they would like you to explain the Capital Recovery Program.
I think we were waiting for Bob to do that, but I'll take it on if you'd like.
No.
Well, I think the question was, can we describe or explain the Capital Recovery Program? Well, generally speaking, and this is a gross overgeneralization, these benefit plans fall into two categories. One where you're just going to spend money as an organization and never see it again, and another where you're going to lay out capital with the expectation you're going to get it back plus a rate of return. And the second example that Bob showed, which we call the CapEx program, falls in that second category. And it's just simply structuring the arrangement where the organization is going to leverage its balance sheet to provide the benefit, but do it in a way in which it's also going to someday get its money back plus a rate of return through the death benefits of the life insurance policies that are involved.
Dale, to add
Great.
to that, I think is important to add to that is in that CapEx approach, as opposed to maybe some traditional approaches of having one policy which tries to provide a benefit and provide repayment. There are actually two policies issued. One, exclusive to provide benefit. Two, a second policy, exclusive to provide repayment. And that way, you have a greater likelihood that both policies perform as expected versus having one policy trying to meet two objectives, which is a benefit for an executive and a repayment to the organization. We probably have all seen those other products because we've all looked at those at some time during our career, and unless interest rates are really phenomenal in the payout of those policies, usually either the benefactor does not get the benefit or the organization doesn't get full repayment, and sometimes those policies are underwater. The collared product under the CapEx with two policies minimizes that volatility as Dale and Bob have both explained.
Great. Thank you both. And the next question is once again directed at whoever would like to chime in, and it is, could you expound on when taxes are paid, at vesting or when the executive receives the benefit? In your examples, were these payments to the executive after tax?
Well, the answer is that all of the numbers we showed in the presentation were net of all costs and all taxes, so it was a proper apples and apples comparison incorporating all of those burdens. In the first example that Bob talked about, which is KEEP, taxation is going to occur when the executive vests, and that vesting under KEEP can be extremely flexible. It can be structured to accomplish the retention objectives of the organization, but when that occurs, there's going to be a taxation that occurs on the amount that was funded into the plan. In the second example, which was CapEx, as long as the organization gets its money back plus a rate of return, and that rate of return is at least the long-term applicable federal rate, and Vic did a good job of just describing the ways in which we've substantially addressed the risks in prior plans associated with accomplishing that, then this is a tax-free benefit to the executive, which is one of its appeals, among other things.
Thank you very much, Dale. And moving on to the next question, it is, how is this insurance approach the same or different than traditional split dollar insurance coverage?
Bob, why don't you take that one?
Yeah, sure. Well, it certainly uses the same regulations that were finalized in 2003. So the types of programs we're referring to here follow that most recent promulgation of the final rules and regulations regarding split dollar. Having said that, the program itself differs mightily in how past programs were put together, is the best way to put it. They usually utilized a single policy structure, and as Vic so well articulated a few moments ago, we use a bifurcated approach using two policies, one that is going to take care of the obligation back to the healthcare organization, and the other to grow the assets for the executive to utilize during retirement. And while insurance can be a wonderful, wonderful vehicle, historically it was hard to find one contract, one type of policy that managed both of those types of obligations to its greater efficiency. One could build death benefit to pay back the healthcare organization, and one could grow cash, but never embodied in one contract. So we migrated to that two-policy approach about 13 to 15 years ago. It also serves as a great way to securitize the repayment to the organization by virtue of that separate repayment policy. Additionally, one of the great differentiators between this current program and prior ones is the use of this equity indexed approach. Historically, most split dollar programs that were used in healthcare used a variable contract. And that term variable means just that. The funds were at risk and invested in the market and could not well endure a year like 2008. And we have always felt, from the time we began in business, that because these are retirement funds, you needed to safeguard them in a way that had not been previously done, which is why we use that collared approach, which locks in past gains and basically doesn't ever let the contract lose its principal. So it's the same insofar as following the most recent IRS regulations on split dollar, but it differentiates itself insofar as the structure itself.
Thank you very much, Vic. And it looks like we have time for another question, and it is, are there any restrictions on loans to officers of nonprofit organizations?
There very well could be. It's actually looked at on a state-by-state basis. In the vast majority of states, this is not an issue. Then there's a second category where initially when you look at it, the state regulations say that there is a prohibition, but then there's a very specific exemption in which the state has commented that compensation-related or benefit-related loans as part of the overall organization's sort of compensation objectives are exempted from that prohibition. And then lastly, there's a very small number of states where it can continue to be a problem, but then there are ways in which you can actually craft the arrangement in which you can structure it where it is not a loan for state law purposes. So we've not been prohibited from doing this in any state. It's just a matter of studying it very closely and involving the organization's own outside advisors to make sure that it's fully vetted and addressed.
Thank you very much. That's all the time that we have for questions today, but I want to again thank our presenters for their excellent presentation and for all of you for participating today. We look forward to having you join us for future webinars. This concludes today's program, and have a wonderful day.